Opening a new credit card may seem like a harmless way to get rewards, increase your credit limit, or consolidate debt, but doing so without proper strategy can seriously harm your financial health and credit score. Many people think applying for a new card is always beneficial, but in reality, each new account comes with potential risks that are often overlooked. From hard inquiries that temporarily lower your score to the temptation of overspending, opening a credit card without a plan can lead to long-term consequences that outweigh the short-term benefits. Understanding exactly how credit cards affect your credit report, interest accrual, and debt management is essential before you decide to open another account. Today, we will talk about don't open another credit card until you watch this. So, before we start, make sure to hit the like button and subscribe to my channel. The first thing to understand is that every new credit card application triggers a hard inquiry, which can temporarily reduce your credit score by a few points. While this may seem minor, multiple applications within a short period can compound the impact and signal risk to lenders. This is especially important if you are planning to make major financial moves, like applying for a mortgage or auto loan. The timing of applications matters. Spacing them out over months can reduce negative effects, while applying impulsively can have lasting consequences. Another critical consideration is the temptation to overspend. Many people open new cards to earn sign-up bonuses, points, or rewards, but the allure of extra credit can lead to unnecessary purchases. This is particularly risky if your income is limited or you are already managing existing debt. Accumulating additional balances increases interest payments and can quickly offset any rewards earned. Wealthy individuals and financially savvy people use credit cards only when they have a plan to pay off balances in full each month, ensuring rewards do not come at the cost of higher debt. Understanding credit utilization is another key reason to pause before opening another card. Utilization, the percentage of available credit you are using, is one of the most significant factors in credit scoring. Opening a new card increases your available credit, which can help reduce utilization if balances remain low. However, if you start using the new card frequently without paying off balances promptly, your utilization could spike, negatively impacting your score. Timing, discipline, and spending control are crucial to ensure that a new card helps, rather than hurts your financial profile. The long-term impact of credit cards on credit history and account age is often overlooked. Opening a new account reduces the average age of your accounts, which can lower your credit score temporarily. Even if your score recovers, frequent new accounts can create a pattern that lenders view as risky, particularly for large loans or mortgages. Financially successful people understand the importance of maintaining older accounts and consider whether a new card aligns with their long-term financial strategy before applying. Interest rates are another area that requires careful evaluation. Many new credit cards come with high APRs, especially those designed for rewards or balance transfers. While introductory offers like 0% APR can be tempting, missing a payment or carrying a balance after the promotional period can result in extremely high interest charges. This can create a cycle of debt that is difficult to escape. Before opening a card, it is crucial to calculate potential interest costs and ensure that you can pay off balances on time. Otherwise, the card may do more harm than good. New cards also bring annual fees, which are often hidden or overlooked when enticed by rewards or bonuses. These fees can range from $50 to several $100s per year. If you don't use the card enough to justify the rewards, the annual fee becomes an unnecessary expense. Financially savvy individuals calculate whether the rewards outweigh the fees and often choose cards with no annual fees, unless the benefits clearly exceed the cost. Another reason to hold off is the risk of multiple overlapping benefits that aren't optimized. Many people already have several credit cards but fail to use them strategically. Opening a new card may provide a new perk, but without a plan, the extra benefits might go unused, and managing multiple due dates and balances can become overwhelming. Before adding another account, it's critical to optimize the use of your existing cards, maximizing rewards, minimizing fees, and ensuring on-time payments. Before taking on additional complexity, for those with existing debt, opening a new card is rarely a solution unless used very carefully. Many people apply for a new card to consolidate balances or transfer debt, but this can backfire if spending continues, or if the transfer fee outweighs interest savings. A disciplined plan to pay off debt, reduce balances, and avoid unnecessary purchases is essential before considering a new card. Without such planning, new credit can exacerbate financial problems rather than resolve them. It's also important to understand that credit card applications and usage are closely monitored by lenders. Opening multiple cards in a short period can make you appear risky, which could limit your access to other loans or result in lower credit limits. Wealthy and financially savvy individuals know how to strategically space applications and use new cards to their advantage, often waiting until a financial milestone or opportunity is coming before applying for new credit. Timing and intention are critical. Credit monitoring and awareness are additional reasons to pause before opening a new card. By reviewing your credit report regularly, you can identify inaccuracies, see the effect of utilization, and detect any potential fraud before it becomes a problem. Many people open cards without knowing their current credit standing, which can result in denied applications or suboptimal terms. Understanding your credit report, score, and utilization trends allows you to make smarter decisions and avoid unnecessary setbacks. Another important factor is the psychological effect of new credit. Opening a card can create a false sense of financial security, leading to increased spending or poor budgeting decisions. Those who are financially successful view credit as a tool to be leveraged strategically, not a source of free money. Maintaining discipline, tracking spending, and using cards intentionally ensures that credit improves your financial position rather than creating a cycle of debt. Rewards and perks are often highlighted as the main benefit of new cards, but they must be used strategically. Many people chase points, miles, or cashback without fully understanding the value or limitations. For example, points may expire, have blackout dates, or require specific spending thresholds. Financially savvy users calculate actual benefits, ensure that they align with their spending patterns, and only apply for new cards when the rewards clearly exceed the costs and risks involved. Finally, delaying the opening of a new card allows you to focus on optimizing existing financial tools. Before adding complexity, maximize the utility of your current cards by paying on time, keeping utilization low, and taking advantage of rewards. This reduces risk, improves your credit profile, and ensures that when a new card is eventually opened, it contributes positively to your financial health rather than creating additional stress or debt. Opening a new credit card is not inherently bad, but doing so without strategy, understanding, and discipline can hurt your credit score, lead to unnecessary debt, and create long-term financial complications. Before applying, consider hard inquiries, utilization impact, account age, interest rates, fees, and your ability to manage multiple accounts responsibly. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.